If you asked any billionaire fund manager what is their favorite metal to watch, it's going to come back as Dr. Copper. Today we discuss what just happened over the last 24 hours for this metal, what it implies for yields moving forward, and also the rest of the market, and whether it tells us that demand destruction and the Fed's job is being done. We'll also talk about how it can pre-warn of previous crash periods. We know that Dr. Copper freaked out before 2020, and then suddenly everything went bad. Well, let's get into it, and we're discussing stocks, commodities, and cryptos today. Well, welcome back everyone to the Daily Show where we talk about markets around the world. If it's your first time here, welcome to the community. Subscribe, smash that like button, and let's go through the news, macro, lead indicators, and of course, hottest charts together. So Elon Musk says he's stepping down as Twitter's CEO, and it looks like there's a lady coming in. Is it Elon Musk? Well, either way, it's good news for Tesla. And of course, we know that the stock was moving up, which is in line with hopefully our move to the gap fill we'll be talking about later on, the 180 area. We also know that everybody's discussing debt ceiling. We expect this to be the discussion point for May into June, and I doubt that it gets done any faster. But basically, it's going to be one of those loggerhead situations similar to 2011. But the big one here is credit default swaps. Jump on over, links in the description down below to our Twitter. If you want to have a look at the credit default swap widening, it is absolutely insane when you think about what's occurred now versus 2011. Certainly an event we now have to pay some attention to. Let's take a look at central bank liquidity before we get into the growth chart. So basically, we're going to be looking at growth versus value and what the market's telling us about this current pickup in growth, whether it's an interesting point or whether it's just more of the same types of data coming out. Well, let's have a look here at central bank liquidity. We can see it dropped off a little bit as we've stayed in the range, though it hasn't moved drastically either way. The market is still overpriced to central bank liquidity, and we know that this is a time to be cautious. But of course, if you're a day trader, scalper, or anything like that, you could be looking at it. Swing traders, I think, are very frustrated with this range. I think we've been in here for 40 plus days now. It's not the best time to be trading indices. Instead, it's been better to trade individual stocks. And we will be looking at a few individual stocks later on, including Disney, after a bit of a horror show earnings, so we can check that out. So we'll keep watching the central bank liquidity. We'll bring it back up with the Qs later on. VIX one day, nothing much to report. Volatility has not gone higher over the last 24 hours. So we're not really seeing a huge spike over there. But we do know that we have still a large movement in tech stocks. And we're seeing growth, of course, as a ratio versus value blowing out again. Now, this is the first time in 24 months that we've seen this really play out. Remember, everybody was like, value stocks are back. Well, it looks like growth stocks are back according to some of these stats. The one-year rate of change spread, growth versus value, is starting to accelerate. We went down to this red line, which is usually a bit of a turning point, and then we have accelerated fairly hard. And this brings us to the stat points of what occurs after we get a reading like this. So this is growth after the growth value ratio registered the first 9-month high after a 24-month low. So you can see there's a lot of reads that have come through on the past, and a lot of them actually go into sideways initially or even downward markets initially, but then come out trumps, especially over the next 12 months. You can see here 2 weeks, 1 month, 2 months. Although these might look fairly positive, the 2 week in particular, only 43% of the time where the market's up over that period. So is that showing us that there's a little bit of weakness here coming forward based on these stats? That's something interesting to keep in our mind. Smart money versus dumb money. It is the loggerheads here. No big changes. Very little edge on this chart at this stage. I just thought I'd update you because many people ask about it in the comments. Hedging against volatility has started to spike up again. We're seeing VIX calls blowing out. Well, this is one of the highest points we've seen VIX calls in quite some time. And it's because of the debt ceiling issues. And it's probably going to do more VIX suppression. So the problem with the VIX this year is it's been unable to spike up during fear events. We saw it barely move during Silicon Valley Bank and, of course, Credit Suisse and everything else. That is very unusual. And although the problems were sorted very quickly, Whenever you've got this, unfortunately, it can lead into VIX suppression, which means more kangaroo market could be present for into the debt ceiling, or at least until they actually spike it over to June. And I pretty much expect it to be at loggerheads until then, though it may change. Fed dot plot, we don't have an update on this, but this will be the discussion. Where is the Fed in regards to the market? Now, with copper falling off as much as it has over the last 24 hours, copper is basically predicting that yields are going to be dropping and the economy is sick. So will the Fed change plan? Now, if they do, the market has been correct again, jumping in the AI QE train. Now, if we also see rates starting to drop off, we'll probably see consumer discretionary start to come along with that, as it's been beaten down as one of the hottest sectors to suddenly the worst sector in the market, or close to, with over 40% down in some stocks such as Amazon, even to this point in time. Let's have a look at the S&P 500, and we can see here the forward PE ratio is still very high. It's actually a bit higher at this stage. We're probably trading about 8.5. For investors, it's not really the time that you would be super excited. You've got to go underneath the hood if you're looking for any opportunity. Otherwise, I still hold to this idea that the midterm here, the next 3 to pretty much 9 months, I suspect we will see cheaper prices. We're looking at this chart here as well as a community, so I'm going to be updating this one on our weekend video, which will show us where the hedge fund managers and the big players are actually going. Are they still accelerating, increasing into this market, or are they remaining neutral in this stage, or are, of course, they dropping? If they drop, we need to be paying a lot of attention to the next weeks past that point. What about rotation? Well, rotation continues to be in certain sectors. Noticeably, since we talked about this, consumer discretionary is on the rise. It's now the second best sector over the last 5 days. Gold continues to struggle. We've seen, of course, regional banks coming under some pressure over the last 24 hours. And it's really just been communications and consumer discretionary that are two leaders. Noticeably, last 24 hours, we also started to get some defensives in there. Healthcare and staples. If we continue to see healthcare, staples, utilities, they're up the top, we know the market's going defensive. Usually a fall is coming. But yeah, consumer discretionary is certainly one that we're spotting and we're watching at this stage. Let's jump over to the charts now, and we'll get into the RSP to start off with here, which is the S&P 500 equal weighted ETF. This shows us whether, if we rip out basically tech, whether the market is actually healthy or not. Notice it hasn't done much, and actually it's had a pretty bad year. So without the big tech stocks, really the underlying market is quite sick. And if we loaded up the US 30, which is of course the Dow, and we look at the futures here, it hasn't been exactly the most amazing run for the Dow either, thanks to banks, Disney, and a few others. Let's move over to consumer discretionary. Are we about to see a big breakout here on consumer discretionary? Well, this is a very interesting sector. It's certainly one of the ones that you would expect to go usually second when we're talking about if we are in a new bull run. And yeah, the sector is trying its hardest. A lot of this has got to do with what the Fed does, though. The market is front-loading, most likely the Fed doing cuts, which could be as soon as September or even earlier. And this is where I think the issue is with the markets. We'll talk about copper in a second to get a bit more of an idea of that. So let's skip over to copper and let's overlay a few things. So firstly, anyone that was short on this, we talked about it the previous day. We discussed the fact that I thought it was going to break because we made the lower peak here, which is very symptomatic of putting a lot of pressure on the down end. Then it just fell straight through, straight into 370, and that's where we find ourselves with copper right now. So it's basically on now a demand again. If we float through this demand and we keep going down, then of course next steps will be these ones down here. But it has bigger implications than that. It shows us that demand destruction is in play, and using certain ratios, you'll be actually able to figure out that most likely yields are expected to now decrease. So that's going to be bad for things like energy in particular, which is a sector I've been very negative on, and of course metals as well. So we're kind of seeing inflation potentially starting to drop off according to the market, and most of that has to do with the Federal Reserve and these rates being higher for longer. Something is sick in the economy and copper is sniffing it out, and usually copper is first to figure this out. It doesn't mean stocks will drop off a cliff, though it does have implications for those sectors, and it also will have massive implications for the XJO, which is the Australian market. So let's load up here the SPX, and then let's load up the XJO, which is the Australian market. And what you might notice is the way in which they all trade. So first up, if we look at the blue line, you will notice that the XJO kind of follows a lot with copper. So copper falls here, and you can see here that the XJO drops. It rallies with the copper price, and then it gets absolutely wrecked here with copper. And of course, we see the XJO go down to a new low. Same with the S&P 500, though, to a lesser degree, thanks to the tech stocks, which do help really alleviate a lot of the old economy that is in these stock markets. If we have a look over here, we see the original drop that happened from 15th of January 2020 when we first found out about all of that stuff. And then we saw a drop in the markets, a rally. Dr. Copper did not like it still. And then all of a sudden, of course, the market caught up. So often this can be a lagging effect indicator. Along with central bank liquidity, I believe it will be one of those reads that we want to be paying a lot of attention to. And copper's move over the last 24 hours really reinstates the idea that the market is expecting rate cuts, and more importantly, it needs them because there is demand destruction. Otherwise, copper wouldn't be falling off like this. So if it keeps going, demand destruction is here in the markets, and they just haven't caught up with really showing you in the news right now. So remember, it's that hidden indicator that we start to use and we start to say, we need to question everything right now about what's going on, specifically with what the Federal Reserve does. And it becomes even more paramount now. When do they cut their rates? Do they stick to the 4 to 6 month pivot period, or do they move somewhere else? HYG, which is junk bonds, not too much move here, fell off a little bit, still stuck in the same range, nothing there. US 2 years started to drop, no surprises with copper also falling. And I expect the US 10 year to be the one that really takes the brunt here. So if US 10 year keeps falling through, we've talked about 3.3, 3.32 a lot. If we close underneath there, that's showing you weakness, superior weakness in the economy, and the Federal Reserve are really going to be forced hand potentially to place cuts. Now, this is what the market is expecting. I still think the Fed should stick for 4 to 6 months on this pivot, but we'll find out who wins. And I think this is where the markets will crack it and get upset if they don't get what they expect from the Federal Reserve. And that's what a bear is looking for right now. They're looking for the Fed to stick to their word, not inject anymore, and not cut the rates. TLT, we saw that go up. Why? Well, it's as simple as yields are coming down. I still could see TLT to 100, though I'm still obviously bullish on this one over the medium term. So the next 3 to 9 months, I still think treasuries are a pretty interesting bet. And then, of course, you've got things like senior secured bank bonds, hybrids in Australia. Those types of things are very interesting as well. So I think there's some of the safe havens. Maybe treasury is even less of a safe haven than the others, considering the debt ceiling issues, though that could create a bit of an opportunity if you believe the US is not going to default, which, of course, I also believe. I think it's naive to believe they will stick to this forever. It's just going to cause some volatility so people can talk about it. Let's move over to the US dollar. What's going on there? Well, it hit into our daily resistance high, and it did seem like it was trying to break out. Still trapped in a range, a little bit of love for the dollar. Weekly close might be key here. How will it close? We've had always weakness. So unfortunately, there's no reason for us to believe that the weakness isn't there yet. If we snap these highs with a weekly close, though, some good trades could be coming up for dollar strength. So we'll keep following that one. Gold was exactly as we thought. This exact resistance zone or around here is continuing to be a problem, 2040. I'd like to actually see gold further fall off and move back down to 1983. And I still think that it's more on the short than the long side at this stage. Although a lot of people, that's not popular belief. We're seeing it start to play out. You can see here also the daily closed slightly underneath the previous daily, which is showing us that there might be a little bit more further weakness to come from this metal. Also, weekly closes will be important because we haven't been able to break through our 2028. So this kind of shows us that we still expect to be in a range-bound market. Now, that's the stats on gold. Gold tends to do poorly over these next couple of months. and then it comes really, really good later on. We'll find out whether it holds. That's, of course, the big thing. Oil, it's dropping, demand destruction, copper, all of these types of things. I expect oil to potentially have a little bit of a bounce. I'm looking for it back into the 72, kind of 75 range. This is going to be a key level for it. We obviously wanted to short heavily through this red area, and we just weren't able to get there yet. From the looks of it, oil is turning to the downside. So I think rallies be met by sell demand. This is certainly a day trader style level. We'll find out whether it does get the right implications in there. Remember, as always, you've got to have patience, react, not necessarily predicting. You're looking for zones, but then you're seeing how the market reacts to those zones. Then you can make better informed decisions. Let's have a look at energy sector. Another pretty poor day for it, actually gapped below. And then we found some buyers here. Of course, a close below there is going to bring us down to 76. And I've been very negative on this sector, along with my negativity on stocks like iron ore. For Australians out there, of course, things like Rio and stuff, they've continued to be pretty poor over the last couple of weeks. And I still expect further weakness here in these, probably down to the 104, maybe even 96 for something like a Rio. Let's move over to Tesla. How is that looking? Well, good news is Elon Musk is coming in, and that's awesome for anybody that's a buyer in Tesla. It was actually up after hours as well, so that's good. And we're looking for it to move into that kind of 180 area. Expected weekly options high this week's 176. I'd like to see it move into 180, fill in some of these gaps, possibly get anywhere in this red box, and then probably resume the downward trend. That would be at least the style you'd be looking at this stage. This 145, 146 gap fill. I haven't lost hope in that. I just said as we broke through this point here, it was likely buyers were in control of this particular stock. Let's move over to Disney. Now, this one took a bad beating and a hammering on the day, 8.73% down. Now, it's off the back of, no doubt, real concerns. But if we look at it from the technical perspective, this yellow line I've had for a while as an interesting zone for people that are looking for, I wouldn't say it's deep value investing, but certainly it's a very board off line by the street, and they usually have liked this zone. Of course, you're buying it after bad earnings, so it could keep flaking off. I do think 78, 71 is not out of the question, so I'm looking for 78, 71 in the future as an alert, but this is a very compelling zone. And we can see that if we go to the daily market, we've started to get a bit more of accumulation through this range. We've got all those classic signs of markets, going down, making new lows, taking out people's stop losses and hunting them. This is the type of Wyckoff accumulation style that you usually see. What I'd like for it to do is hover here for a few days in a trade range and then gap up. I will be watching Disney. I'll be updating on the channel. Make sure to subscribe if you're interested. Google kept breaking out as we suspected it would. We are in the problem zone, so we actually hit a good target profit. 118 was a very good target profit. Fills one of those gaps. Nice. And also gets to the middle or the higher range of a big trade zone that was in here. If we keep going with Google and we go back to 123, I think there could be issues there, but that was a fantastic big breakout, huge moves. Why? They mention AI a million times, something about Wendy's. It doesn't really matter. The point is it's moved to those key levels. So Google, while I still think it's not too badly priced on the charts, it's kind of hit that resistance faster than even we expected. One day and it was there. A lot of people are looking at Meta at the moment. They're saying, is Meta a possibility of a turnaround? It's gapped up after earnings and it's hovering. So we haven't seen an island reversal on this. We will be watching, and Meta is on the watch list at this point, potentially for the bearish action. I know a lot of people are going for this gap fill to 300. Not sure if we're going to get that one. We'll find out. KRE, regional banks, they were down hard on the session. Around in this area here is usually where you would expect them to come up if this is a squeeze rally. So if this is trapped shorts in, you would expect usually around here to find it. This is not a trade that the faint heart would take. This is certainly one for people that have got the cojones to get in there, because KRE is it takes very good risk management to deal with that sector. Nvidia still hovering around this zone. It did a small change of trend, very small change of trend on the low end timeframes. I'd rather it actually gets underneath 272 before you actually say this thing is short. So it's done a miniature change of trend, which could mean that these little rallies in here might be sold off, but really it's not enough yet. To stop the freight train usually takes more. I'm looking for 272 and under, and then a rally, and then probably a sell-off. Let's move over to the DAX. DAX is struggling. Is this a UTAD? Question mark. A lot of people have been sending it through to me. Not enough information yet, unfortunately, for DAX traders. We are looking at all markets to consider weakness, but yeah, just still trapped in the range, still waiting for more information. Old XJO, not down as much as you would think today, considering copper. Usually it would hit more. There are defensive and old sectors that are doing well. Of course, iron ore is down across the board. So yeah, it's just having a bit of a relief rally. Still looks, strange. I mean, some people might think that's a flag towards buying. Yeah, well, we'll keep watching it. If anything, I would probably still say weakness in the Australian market is more than likely. IWM, range bound, long leg doji, totally boring, not much to discuss. Same thing on the futures market for it. We've got this short potential zone that was very good for us over here in particular, and we haven't broken underneath 1700, so we're totally stuck. What about the Qs? Now, the Qs are starting to accelerate away from central bank liquidity, and we know that that's usually dangerous. We don't like dangerous, and I do feel like the danger zone is potentially starting to come for tech stocks. But when we look at the futures, it probably is not yet. There's probably another 100 plus points of rally here in the NASDAQ before things get weak. I would be likely that this thing would probably go into something around 13,500 to 13,600. We don't want to short this dulling market at this stage. While it's not accelerating at the same pace, once we got up here, well, what can you do? We're looking for the thing to stupidly rally. S&P 500 is telling us something totally different. But yeah, the NASDAQ's still on a bit of a runner here, and it's being led now by probably stocks like Tesla, Amazon, Google, those types of things. They're the ones that will be running it just because it's, we're basically seeing a bit of a rotation into potentially consumer discretionary and other growth sectors, as we saw the stats were there. But as we approach these levels, very interesting, especially how the S&P 500 deals with that. So underneath the hood's a lot sicker. This is just, what is that? It's terrible, isn't it? If you look at it on the SPY, it's like gap up, gap down, gap up, gap down. Nothing much going on. This is theoretically where bears should be looking to short because, of course, we saw that switch to the lower low. But then we got the island reversal towards the bull side. We got this false break, question mark. Very tough trading in here. I do think individual stocks have been better and still continue to be better until we get rid of this range. Look at this, super boring, heavily traded zone, very lackluster inside of this range. We'll be looking for closures because you can't trust the wicks, closures outside of these 4110, 4160 zone. And at this point, we're still trapped in here until further notice. So we'll actually have to just keep looking at that. When we look at the options next week, things change a little bit. So we'll refresh this. Now, this is the max pain options for the one that matters, the 19th. So the 19th of May, 400 puts remain incredibly stacked. The calls are coming through though, but look at that 400. Wow, everyone wants to be on that. Max pain is now at 405. And that hinders the idea that maybe there's weakness coming in first because there's actually more money to be made by the street to possibly breach towards the downside next week, push into the 400 or push into the 405 by the end of it, and then close all the positions. Remember, this is 2.5 million units. We're talking trillions of dollars at stake. And yeah, certainly a lot of 400 puts. I don't think they're getting paid. But also we've got 420, 425 calls. So it's unlikely we can get through that too easily either. I think that unfortunately S&P 500, the downside risk looks more probable. But yeah, because of the central bank liquidity, because of these options, because of the expiration and everything. But even the top end risk looks limited. It's really just the NASDAQ that's putting the squeeze on at this stage. Now, I missed Bitcoin in the last video, but yeah, nothing has changed in terms of our analysis. we still, like from a head and shoulders perspective, you would say it's on. So this is left shoulder, this is head, this is right shoulder. I'm still cautious around 26,600, but Bitcoin does look quite weak. Daily close was a new low. Daily close is lower than all these other points and even these points over here. It really has to find buyers immediately with these wick ranges. But if we get another close underneath here, I think Bitcoin's going to 24,000. And if we combine some of the recent indicators, let's say we think Bitcoin is risk on, risk off. So that's currently looking down. We've got central bank liquidity, which is currently looking down. We've got maximum pain next week, which is currently looking down. And then, of course, we've got the growth stocks in squeeze. So these are some of the things that I'm looking at this stage. Dr. Kopp is also telling us there's some weakness here. There are a lot of negative portions, but I don't know whether you can go against growth stocks at this stage. It's just they're in the middle of nowhere on the NASDAQ, and there's some squeeze that's been pushed through in the last couple of days, which, of course, is why we haven't been looking at even touching that market from the short end. All right, let's move over now to the news coming out. We only have one bit of news left, prelim UOM consumer sentiment, and that's coming out at 10 a.m. PPI was not that interesting. It basically came in on target, so yeah, the market didn't react too much to that. But yeah, that's the big stuff. If you're interested, look at the link tree in the links down below. Follow us on some of our other social medias. Grab a couple of free trading cheat sheets if you want as well. And yeah, I want to wish you all the best of luck on the Friday. Thanks so much for subscribing. Smash that like button. Bye for now.